Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day and spending it with us. As I say often at the start of each of my shows, we try to provide answers to some of the most common questions that many investors have at that time or at this time today. And I think our show today goes a long way with regards to that. We're going to answer a bunch of the questions that I've been receiving over the last few weeks, questions I've been receiving on the radio, questions I've been asked on TV, questions I've been asked about by investors when I just travel around the city. There's a lot of questions. A lot of individual investors aren't sure as to why things are happening the way they are. So today's show is really going to hit home with respect to the answers to some of these questions. So let's put up what these questions or topics are for today. Our first topic, I call it the chase for profits. Markets are at all-time highs. Individual stocks, many of them at all-time highs. And so there seems to be an investor's appetite for chasing the hot stock or chase for those profits. We're going to delve into that. As always, our top 3 things to consider over the next 5 to 10 business days. What should you be looking at, considering, focused on before you make your investment decisions? Are we in a tech bubble? A question I get quite often right now. I actually spoke about this on the radio the other day. Many are nervous that we're seeing similar days to what we saw back in 1999, 2000, and 2001. Why are the markets hitting new highs as US and Canadian economies continue to slow? We're seeing a slowing of jobs. We're seeing a slowing in Canada, GDP. Yet Toronto Stock Exchange, Toronto stock market is at all-time highs, just crossed recently 30,000 points. How is this possible? Valuations, are they stretched? Are they too high? Is this market too expensive? We're going to talk about that as well. Quick hits, as always, 3 topics that I've come across in the news most recently, and I wanted to talk a bit about each of those 3 topics with you today. And last, but definitely not least, as always, your questions. If you have any questions regarding the markets, your portfolio, anything with regards to investing, please put them in the chat box, and we will gladly try to answer some of those questions at the end of the show. And if not, we hopefully will get to them at the end of the next show. So without further ado, let's move forward with today's show. Chase for profits. As I mentioned, we all know, or many of us know, that the markets are near or at all-time highs, whether it's the NASDAQ, whether it's the Toronto Stock Exchange, even the Dow is in that area, Russell 2000, which are your small cap stocks in the US. Markets right now are at all-time highs. And it's interesting because you're getting a lot of, or at least I've been getting a lot of questions from investors asking me, Allan, what about this Broadcom stock or NVIDIA? Should I be buying it today? Stock's gone up by quite a bit. Is it going to continue to rise? Should I be putting more money into it? And I've been getting a lot of questions from individuals that normally wouldn't be asking these types of questions. Normally, they'd be content holding, I would say, less volatile names, stocks, or less volatile or lower risk investment ideas in general. But there has been this thirst for stocks recently. The chase for profits has led many investors to buy stocks that perhaps normally you would not see these investors in the stock market. Our first chart clearly shows this. It is the graph, and tough to see what it says along the top, but what it does say is it's a graph which shows 45% Americans direct or indirect stock ownership so as of September 11, 2025. And so you can see here very simply that over the last, well, let's call it 20 years or longer, people have been piling into stocks. It's been that chase for profits. It's been the opportunity. If you're not in the market, you're at an opportunity. You're costing yourself significant growth. With interest rates as low as they are, I've used the acronym on the show before, TINA. There is no alternative to the stock market for growth, especially when interest rates are as low as they have been at times, as low as they are now, and possibly going lower as the Bank of Canada just cut interest rates by a quarter point. The Federal Reserve is cutting interest rates recently by a quarter point, and both banks look to cut interest rates even further at our next meeting. So with that in mind, yes, more people are piling in to the stock market. Our next chart here is of a stock that I've talked about many times on our show, and that is Broadcom. They are a diversified company, not all eggs in the AI basket. They make custom chips, as many of us know. It's a bigger and bigger market for them. They also own other parts of the business, software as well. VMware is a company, a massive company that they've just purchased over the last few years, which broaden their business, getting them involved in many different areas of the market. But if you piled into the name most recently, well, you can see how well the stock has done. But if you look at the kind of the top right-hand side of this chart, you can see that Broadcom stock has started to fall off. This stock was about 17% higher at one point and just in the last few months. And so if you were chasing profits, if you were chasing the hot stock, and if you were chasing a name like Broadcom, you possibly would be disappointed if you bought shares recently. Now, of course, if you own shares for a little while already, perhaps it would be a good idea to trim some of the profits there. And as some of my investors would probably tell you, that's what we've been doing, taking some profits off the top, still owning the name because I think it can go higher. But the prudent thing to do would be to take some profit. Another name, and this is an interesting name, called Oracle. And the name Oracle, many of you might recognize, but I think most people don't recognize. They're a data center AI, data center infrastructure investment software, a massive name. Larry Ellison, once CEO of the company. Now I think he's the chairman. At one point, when Oracle, as you can see here on the chart, it went up, I think, 35, 36% in one day due to what they said during their earnings call, that potential business down the road would be massive from the hyperscalers, from the names, the biggest names in the world, the Googles and the Metas, et cetera. Their business would continue. Their backlog, they announced, was quite substantial. Stock went up 36%. What happened shortly after? Had you piled into this name, chasing the profits, the hot stock? Well, you can see Oracle has come down significantly. It's come down by, I would say at one point it reached a high of close to $340 a share. So you can see it's down about $60, almost 20% from the high, and it's given back a lot of its gains. So once again, this chase for profits in most cases just doesn't work. If you see a stock going up and valuations are starting to get stretched because of that, then it's a name that you probably don't want to pile into, and perhaps you take a bit of a pass if you don't own it already. The next chart that I have here called Emera. Now, for those of you that don't know Emera Inc., they are just a plain Jane utilities company out in Eastern Canada. However, if you own this stock, it pays a 4 or 5% dividend. Right now, somewhere around, in between 4 and 5%. But if you own the stock over the last 6, 7 months, you would have had roughly a 15, 20% return on the shares, capital gains that is, and you'd be getting this 4.5% dividend as it sits right now. So I wanted to compare this chase for profit versus owning a good quality utility, something that many would say, oh, it's just boring. And you could still, and this example clearly shows that you could still make money from good quality, as many would call boring names. And, the other day I was talking to an investor and I said, I have this idea. I think it's good to make, 20, 30%. I think the shares are undervalued and that's what you can make. And they turned around and said, Allan, 20, 30%, that's nothing. These days, people are making 50% in NVIDIA or Oracle or Broadcom or whatever tech stock they may have heard. I couldn't believe it. Since when does a 20 to 30% return not become enough? Well, it's not enough if people are chasing these hot stocks, and they've been hot for quite some time. They're your big cap tech names. A lot of them are a part of the Mag 7. or it's an AMD or whatever it is. They're artificial intelligence in that area or that space, and they've made investors a lot of money. So I guess my main message is this today. Don't chase that hot stock. You never know when you could have an Oracle on your hands or even a Broadcom whereby it has a quick pullback. Wait for a dip before you buy some of these names, especially if they've really gone significantly higher. I'm not saying not to own them at some point, but for example, I've been looking at Microsoft. I looked at Microsoft for years before I had an opportunity to buy on a dip and back in 2022, and I've been a buyer ever since. So you want to do your homework. You want to look at good quality investments, but you want to buy them at reasonable prices. And I think if you do that and not chase the hot stock or have that chase for just profits, I think that is the best way to grow your portfolio over time and the best recipe for success. Now, the part of our show, as always, where we talk about three things that individual investors should be focused on before they make your investment decisions. And as I guess everybody would say, this is a pretty popular part of our show. Our first one, U.S. job numbers update this Friday. Well, we were supposed to get U.S. job data this Friday, but due to the government shutdown that's currently ongoing, that started at midnight, I guess, this morning or last night, the U.S. government is closed right now, and that data, unfortunately, may not be provided to us. However, we did get ADP numbers, which are private payrolls, which are private jobs, and those numbers were actually somewhat disappointing this morning. So we'll talk about that and what may or may not happen. Take emotion out of investing. I think this is extremely important. A lot of emotion out there. When you say the word president or the two words, President Trump, that elicits such emotion from so many people. You either love what he's doing or you don't like what he's doing, and there doesn't seem to be much in between. You have to take emotion out of investing, and that is something that individual investors need to consider always, not just over the next couple of weeks, but always. Understand what is happening in the markets and why. Again, with this chase for profit that we're seeing, many individuals are asking me questions. Should I be more into the Toronto stock market? It's going higher. It's outperforming the US markets this year. Is that something that we should have more of, more names that trade in Toronto? Well, I think you need to understand why the Toronto stock market is going higher before you can actually consider owning more TSX names. So understanding what you have and understanding why it's moving higher is clearly very important. So let's take our first point, US job numbers update this Friday. And as I said, we may or may not get these job numbers if this government shutdown should end very quickly, started this morning. And if it should end, let's say later today, I think it is very possible we could still get those numbers. Canadian jobs numbers do not come out until the following Friday, which I believe is October 10th. And we'll get those jobs numbers in Canada. And if they are weak, as they have been over the summer months, over the last few months, then I think we are a shoo-in for another quarter point basis cut by the Bank of Canada. Our first charts here show some data that we did receive. One is the JOLTS number, which are job openings and labor turnover. And you can see the job openings are falling. There are not as many jobs available in the US. And on the right-hand side, you can see hires and total separations. So hires are also kind of flatlining, slightly down. What we're actually seeing in the US is that people aren't really getting fired, but they're not hiring new individuals either, which is quite interesting. Those that are retiring or deciding to leave the business is just not hiring new people to replace them. They're asking for the existing workforce at that company to pick up the slack, to do more. And so we're seeing hires not go up. We're seeing fires not go down or go up either. We're not seeing as many job openings because companies are just not hiring. So we're just seeing a bit of a stagnant situation. Our next chart here shows the most recent data out of the US. And there you have it, showing very little job growth, excuse me, over the last few months. 22,000 jobs created last month in the month of August. And you can see over the last 4 months, we've had a lot of job disappointment, a lot of negative revisions. And the jobs number that was supposed to come out on Friday was going to go a long way as to tell us whether the Fed will consider or cut, or the likelihood of the Fed to cut rates in at the end of October. We won't get, I don't believe, the October number before we get a decision, a rate decision by the Fed. So this number was going to be the last one, and hopefully we will get that jobs data at some point in the not so distant future, so all of us can figure out what the Fed has on their minds and what they're going to do. Our next, I guess, our topic or point that individual investors should be considering before you make, as I mentioned, always, if you make any investment decision, not just an investment decision over the next 2 weeks, but an investment decision just in general. And that is, you need to take emotion out of investing. And sometimes your emotion tells you to do one thing, but the smart money is doing the total opposite. When in stocks or investment ideas are trading at low points because people are nervous, there's volatility out there, the headlines are negative, that's the time where you got to gather up the courage and buy. And the times when everybody's buying, there's that chase for profits. Everybody's talking about buying stocks, whether it's AI, technology in general, bank stocks, whatever it is. Your next door neighbor telling you that they're making lots and lots of money. That's when you probably want to be cautious. And whenever we talk about the emotion side of things, always I like to show the cycle of emotions, which is our first chart in this segment, investment emotional cycle. And you can see here, right in the middle is the point of maximum risk is actually at the point where the markets are at its highest. So yes, we would say that right now, with markets at all-time highs, yes, we're at maximum risk, because to keep or make new highs, to stay at these highs or make new highs, things have to continue to go great. I don't want to say perfect, but they have to be fantastic for us to see the markets continue to move higher or individual stocks continue to move higher. And as I mentioned right away off the top of this segment, the point of maximum fear is when the best time to invest. That's when the markets are at the bottom. And as you can see, you have the best potential for moving higher. So taking emotion out of investing, I think, is the number one thing. As an investment advisor myself, that's what I try to do. And a lot of people will say to me, Allan, I love Apple. I own all their products. They just had a launch of new iPhones. Everything looks so great. The new sleek, very thin iPhone. It's popular. It's this. Shouldn't we own shares of Apple? Well, maybe. But I can tell you that Apple stock has gone nowhere this year. Recently, it's gone up. And earlier in the year, it went down. So if you look at where Apple traded in and around end of December last year, it was about $255, $260 a share. And guess what? Here we are at the beginning of October, almost 1 year later, and the stock is in the exact same place, 255, 260. So again, if you let emotion get the best of you with respect to buying Apple stock because Apple can do no wrong, and you're part of that environment, the whole Apple ecosystem, well, I think you would have been disappointed watching many other stocks move higher or investments moving higher, and Apple just didn't move higher. And what causes this emotion? Well, headlines. Headlines in the news, headlines from President Trump, headlines from Prime Minister Carney, and some of the headlines that we put together for you here, some of them, or many of them, actually negative. One at the top there, as tariffs hit, people grapple with rising bills and multiple jobs. Another recession indicator as consumer confidence declines. Lumber hit with new Trump tariff sector calls. It's misguided. Trump selling a strong economy. Voters aren't buying it. The one at the bottom, hit by Trump tariffs. Rest of the world races to forge new trade alliances. All of this gets you going, right? It gets you going. It gets you thinking. Either you love what the president's doing with some of these headlines, or maybe you just don't. And it's not just President Trump. You have a lot of headlines that come out of certain companies. I get calls from people every day. Allan, it's so nerve-wracking right now. The economy is in shambles, and all of this, should we be selling? And I say to that person, I say, economy in shambles, I don't know what you're referring to. But if you're looking at the stock market, if you're right and the economy is slowing down, which yes, it is, stock market's at all-time highs. So emotion, if you let the emotion get the best of you, you're just not going to make the right decisions when you need to make them. And an investment advisor is there to help you, keep emotion out of it before you make your investment decisions. Our third topic, which is off the top, where I said you need to keep in mind before you make your investment decisions, is this idea of understanding why things happen the way they do. One of the questions I get often is, TSX, Allan, is outperforming the US market this year. Maybe we should own more Canadian stocks than stocks outside of Canada, stocks outside are in the US. And I say, well, do you understand why Canada Stock Exchange is doing so well? And the investor will say, I'm not so sure. Well, our first chart will show you exactly this. And it is a great chart, one of my favorites, possibly my favorite for the show. It shows you the different sectors of the Toronto Stock Exchange. And I know it's a little blurry, but if you look at the purple, which is the top line, it shows a roughly 68% increase. That sector, if you look along the top, is the materials sector. And what is it part of the materials sector? Gold. So one of the main reasons why the Toronto Stock Exchange is doing as well as it is because of gold stocks. Gold hit or is around $3,900 an ounce US today, this morning, before I came on air. Gold stocks have been the primary driver of what's been going on here in our country. Yes, Canadian bank stocks have had a fantastic run. It's made a lot of money over the past, let's call it 9 months or so. Your big five Canadian bank stocks have done extremely well, but nothing in comparison to what gold has done. So you look at gold, you look at banking makes up about 31%. Gold, not as much, maybe 13-ish%. Oil makes up about 17% of the Toronto Stock Exchange. We know oil hasn't really done anything this year. Price of oil has been hovering around $63 a barrel, WTI, for oil. So really, it's been gold. And that's what I mean. You need to understand why things move the way they are. So if you want to own gold stocks, sure. But if you're going to look at other sectors that aren't as volatile as gold, because I still believe gold is higher risk, then maybe you don't want to own many stocks on the Toronto Stock Exchange that trade on the Toronto Stock Exchange, because there aren't really that many good performers outside of the banks, outside of gold. You have a bunch of others. Celestica's done well from a tech perspective, Shopify, but you got to be careful. You got to really understand why things happen the way they do. Our next chart here is another example. And I actually had this question from an investor not that long ago. And this investor said to me, we can put up the chart, the next chart, Allan, Tesla. How can Tesla be worth so much money today as a car company when if you compare what Tesla does to the other car companies sell way more cars than Tesla, yet the market cap of Tesla, what it's worth today, is so much higher. And he's 100% correct. Look at this chart. Tesla, $1.4 trillion it's worth today. Ford, $46 billion. General Motors, $55 billion. Stellantis, formerly Chrysler, just under $27 billion. The three car companies put together are still, what, not even half, a fraction of what Tesla trades at in terms of market cap. And then you look at car sales, 633,000 for Tesla, and the others are to over 2 million, 2.08, 2.7, 1.3. So why would Tesla trade so high? And this is where you have to understand why. Well, simple answer is because Tesla is not trading like a car company. Tesla is trading like a technology company. That's why you can give them the high multiples, whether it's right or wrong. And I'll show you a little later in the show what their multiple is. And it's something that kind of scares investors because it's so high. But it's the future potential of Tesla. It's the robotics. It's the robo-taxis. It's all the AI, the Grok, artificial intelligence. It's the future. And that is why individual investors will continue to invest in Tesla because they believe in Elon Musk. So when you want to compare Tesla to these other car companies, there is no comparison. So when someone's trying to say, well, this is silly. I don't want to buy Tesla. Well, if you're doing it, or if you're looking at Tesla as a car company, for sure, you're not going to be a buyer. But many people are buying Tesla because they're looking at it from a futuristic standpoint, and in the hopes that Tesla will, I guess, grow into their valuation at some point when the robo-taxis come and the robots come, because that's what Tesla represents to many people. So understanding why you're looking at things to buy, why they're higher, why the index is higher, this is so important. And you couple that with the data, economic data of the U.S. Hopefully, we get a jobs number coming out of the day on Friday, and taking emotion out of investing. That is obviously something, as I mentioned, that individual investors need to do always. And if you look at these three things, I think it's going to help all of you make better investment decisions. And hopefully, you can own some good quality names, trading at nice multiples, and understanding what you own when you buy them. Are we in a tech bubble? A question I get received on the radio a few times. And I think it's because, the question's coming up because technology stocks have surged so much more than pretty much everything else. Technology, as I've said many times, makes up 40 to 50% of the S&P 500. Not Tesla, my apologies, NVIDIA. NVIDIA alone makes up 8% of the S&P 500. And as our first chart that we can put up will show you, the Mag 7, the biggest 7 stocks in the United States, make up 34% of the S&P 500 with respect to market cap. If you look at, in our last show, we looked at the Mag 7. They made up about $20 trillion, bigger than the Chinese economy. Just those 7 stocks were basically worth more than the whole Chinese economy itself. So no wonder why people are saying, is this a tech bubble going to burst again like we saw back in 2000, 2001? Well, let's take a look. I went back and I pulled up some of the stocks at their peak valuations, and I wanted to see what those stocks were and compare them to what those stocks are today. And interesting enough, a lot of these companies, a lot of these dot-coms or tech companies didn't even make money. Now, many on our list that I'm going to show you in a moment did make money, but many didn't. Bid.com or this.com or that.com, they were always future potential. It was the internet and the promise of the internet that really got everybody excited. When the marijuana stocks came out in 2017, everybody was excited when marijuana was legalized. Well, look what happened to many of those stocks. A lot of companies merged together, were bought out, went bankrupt, and now that sector is tiny in comparison to anything else. And many of those stocks lost most of their value. So the tech bubble. Let's take a look at some of the stocks that, or at least the top 10, that had, by market cap, that collapsed after the dot-com bubble. You remember WorldCom? Their CEO went to jail, actually, and $180 billion in 1999, went bankrupt in 2002. They obviously, their CEO went to jail because their business was not legal. They were doing illegal things, and we all remember the WorldCom days. Lucent Technology never recovered, lost most of its value, and it ended up being bought out. Nortel Networks. Now, this one, everybody probably knows. Nortel actually had to do a double take, went bankrupt in 2009. I didn't realize that. I actually thought it went bankrupt earlier. And Nortel really struggled after the tech bubble burst. But Nortel, like NVIDIA today, if I can make that comparison, Nortel was in every mutual fund. Nortel was pretty much a part of many of the indices, ETFs, etc. And it was very difficult when Nortel went bankrupt because it took down the market. Some of the names you may not be familiar with: Global Crossing, JDS Uniphase, and here it comes: Excite at Home, Webvan, eToys, Pets.com, NorthPoint Communications. A lot of names that, if you look back, you probably don't even remember them. They were that small. They were 180 billion, 260 billion, 35 billion. Many of these companies did one thing and one thing only. Whereas today, if we now switch to the top 10 by market cap companies in the world. Let's put that chart up. You can clearly see, and this is actually in Canadian dollars, not US dollars. Nvidia is worth about 4.5 trillion US, over 6 trillion Canadian. That's trillion with a T versus the other list, which was billions with a B. Microsoft, Apple, Alphabet, Amazon, Meta, formerly Facebook, Saudi Aramco, that's obviously outside the tech space, Broadcom, Tesla, TSMC, which is your Taiwan Semiconductor, all these big cap tech names worth over $1 trillion. Some of them over 4 trillion, well, Nvidia over $4 trillion market cap in US dollars. And on top of that, not only are these stocks much bigger than what we saw back, obviously, in 2000, 2001, these companies are not one-trick ponies. These companies had profitable businesses even before the AI boom. Microsoft, Apple do so much more than just chips or cloud. They're in software, Microsoft, hardware. Microsoft owns LinkedIn, Windows, Office. They're everywhere, and that is quite impressive. Apple does a lot more as well. Google, their primary business is search. Their cloud business is growing at 30%, but their primary business is search. Meta, over 3 billion people use Meta apps every day. Yes, they're involved in the AI rush, but they do so much more. So to say that we are in a tech bubble, I just don't believe it. Now, can we see these stocks fall? Absolutely. I could see a dip of 5, 10%, the market pulling back, and these names would lead the pullback because, as we all know, you usually sell what you can versus what you need. And so selling what you can are these companies because they're the ones that have gone up the most. So yes, we could see a pullback in these names, but it won't be because we're having a tech bubble situation and a burst of that bubble. I just think these companies are way too diversified, way too profitable. They're all profitable versus a lot of the dot-coms back in 2000, and they're just way too big and diversified. So for me, are we in a tech bubble? I'm going to say no, but that doesn't mean stocks can pull back. But I think that pullback will be met with that old adage, buy the dips, and I think you'll see these names just go right back up again. So why are stock markets at all-time highs when the economy is struggling? As I said earlier in the show, GDP growth in Canada, non-existent. GDP growth in the US has actually been quite strong, but many people, including myself, believe it's because of a lack of imports. The United States is not importing as much. They continue to export, but obviously due to tariffs, imports are slowing, and that has boosted GDP numbers. Obviously, if you're not paying for imports and you're still exporting the same, your costs are down, and your numbers look a lot better. But the consumer is still strong. Retail sales are up in the US. But overall, jobs, as I've said earlier, are slowing. So is the US economy slowing? That's a question that the Fed struggles with and investors continue to struggle with. But make no mistake about it, the markets being at all-time highs, is it matching the economy? And I tell individual investors sometimes that there are periods of time where stock market can get ahead of the economy. Perhaps those things don't match up, and we can show some of the charts of some of the indices. S&P 500 near at all-time highs. Look at that chart. What a beautiful chart from April lows when tariffs were announced all the way till today. S&P 500 making new highs on a regular basis. Let's go with the NASDAQ. NASDAQ crossing 22,000 almost. Well, actually, I think it came closer, just crossed 23,000. Today, 22.6. Again, just off its all-time highs. Again, another beautiful chart. And last but definitely not least, the S&P, the TSX crossing 30,000 points. That's something that I don't think many people anticipated this year. Look at that chart, beautiful chart on the back of great performances by our banks, by gold, some of the commodities, some of the tech names. These charts have looked fantastic. But as I said, sometimes you can see these situations come about where you have a weakening economy. Now, the question I think investors have to ask is, what moves towards the other? Does the economy get better and justify the gains in the stock market? or is the stock market pull back to justify the slowing growth of the economy? That is the question that I think that people have to ask themselves. And we also know that this market tends to move more with the US data than the Canadian data, and that can throw people off as well. So people will say, Alan, I'm afraid to invest in the market because the Canadian data is so weak. Well, if you look at some of the points, and we can show a quick chart, our next chart on this, some of the macroeconomic indicators like CPI, like unemployment rate, GDP, as I said in the US, retail sales very strong, GDP very strong, industrial output. These are some of the data that comes out of the US on a regular basis. And these are the data that I think people focus on more. Even Canadians, our market tends to move more so with the US data than it does with our own data. So getting back to the question, how can the market continue to move higher when economies look to be slowing? Well, US data continues to be strong. That helps. And there are certain points in time where the stock market can deviate away from the actual underlying economy itself. And so to me, that's most important, is to figure out what's going to move towards which. Is the economy going to get better? Is the stock market going to move down? That is why we continue to look at the data, and we continue to try and figure out what the data means, and to figure out how this market will move going forward. Market valuations, are they high? Are they stretched? I would say yes. We know that when you look at the market, which I do, on a forward-looking PE ratio, so price to earnings multiple, but forward-looking. We get PE ratios all the time from companies when they report earnings, but that is looking in the rearview mirror. That is their past quarter PE. I want to know what they're saying going forward. And we know when you look at the S&P 500 on a forward earnings basis, forward PE, it's about 23 times. Quite expensive, actually. However, if you look at the market and say to yourself, okay, what if we evaluated every company as the same weight? Not look at NVIDIA being a $4.5 trillion market cap, not Microsoft being, about a $4 trillion market cap, or Apple. We're going to take all the companies and we're going to give them the same market cap, same weight. What would the S&P be trading at? Well, the answer is about 18 times. So you can see how much things are skewed because of these large companies. And so I think you need to keep that in mind when you say the market's expensive. Yes, the general market is expensive, but if you use an equal weighted system and you said, well, let's take a look at every company if they were the same size, then market wouldn't be so expensive. I would say it'd be maybe fair value, maybe slightly cheap in some areas. Our first chart that we have here actually shows that the valuations, S&P 500 valuations at the highest level since 2021. And this is interesting because recently Jerome Powell, the Fed chair, said that the markets, in his opinion, were actually overvalued. We've heard this before from a number of Fed chairs, the head of the Fed many times. Alan Greenspan, said it when he was the head of the Fed. And it was an interesting thing to look at this chart, and that's why we brought it to you. It seems like every time, and you see the lines there, every time the Fed seems to warn about stock valuations, stock market goes up even further, which is quite interesting and actually quite humorous. So whenever you hear the Fed tell you, well, stock markets is expensive, is that a time to buy? Is that a contrary indicator? Because in the past, it seems like that is how it's been. But let's look at our next chart, S&P 500 PE ratio, and you're going to see, other than that big spike that we had back in 2000, coming out of the financial crisis, you can see PEs are starting to climb, and they are starting to climb quite substantially. So yes, things are a lot more expensive. However, with any market, there are pockets of stocks that are expensive and stocks that are cheap, and you really have to know which ones are which. So I have a few ideas or a few examples. Let's show a chart of Tesla. Mentioned Tesla earlier in our show. Tesla today, and there's the stock, market cap, $1.5 trillion approximately. It's the most I've ever seen Tesla worth. And that has a lot to do with what Elon Musk has done recently. He bought a lot of shares recently, talk about his pay package recently, talk about robotics, etc. But Tesla trades at about 270 times forward earnings. Outrageous. So anybody who tells me, is Tesla a good buy? How can I possibly say yes? The only way you would buy it, in my opinion, is if you had some speculative money that you were okay to lose if you lost it, that you could sort of dabble with a name like Tesla because it is so expensive, so outrageous, yet the stock keeps going higher as you see on this chart. Our next chart is Broadcom. Mentioned this earlier in the show as well. Now, Broadcom at the peak, or even now, their PE ratio or their forward PE is also very high. Broadcom trades at 50 times, more expensive than NVIDIA, more expensive than AMD, more expensive than a lot of chip makers. Broadcom is expensive at these levels. It's come down quite a bit, as you can see here, from its highs, but still very expensive on a price to earnings multiple. And our third chart, a name that many people have come to know, and maybe some of you own it, Palantir. Let's show a chart of Palantir. Palantir, there it is. Wow, what a beautiful chart. But everywhere along the way, this stock has been expensive and continues to be expensive. Palantir trades at 288 times forward earnings. Is this company ever going to grow into its earnings? I'm not sure, but it doesn't seem to stop people from buying the stock. So when people ask me, what about Palantir, Allan? Do you think it's going to go to 200, 250? It just might. But is it a good value? Is it a good quality name? Yes. At a good value price? No. And that's what keeps value investors, or even GARP, growth at a reasonable price investors, away from this name. On the flip side, let's go to a couple of names that are cheap. And we've talked about some of them in previous shows. First one we have, U.S. Bancorp. U.S. Bancorp, seventh largest bank in the United States, pays a 4.5% dividend. Stock trades at 11 times earnings. Would you want to own stock that is so cheap, cheaper than most other banks in the United States right now? Seventh largest, so it has staying power, super regional bank. I think you might. Another name that we have that, well, if you're considering, well, Allan, this is a bank, you are showing tech stocks. Let's show a tech stock. Let's show a couple of tech stocks. Let's show Google or Alphabet. Where does Alphabet trade right now? Look at that stock. Again, just slightly off its high, but Alphabet trades at 24 times earnings, well below Palantir, well below Tesla, and less than half of what something like Broadcom trades at. Meta trades slightly above that, maybe 27 times forward earnings. Another name that we have here is Qualcomm, a chip maker. They provide chips for pretty much all of the phones that are out there. They provide chips for automobiles, very large company. Qualcomm, chip maker in that chip making space, 13 times earnings. Pay a bit of a dividend, not the biggest dividend, over 2%, in and around 2%. So these are names that I think you could get behind. These are names that I think are good value. So is the market overvalued? I think yes. In some places you can make that case. But there are a lot of things to buy today. And when investors email me or call me and say, I have some money to invest, do you think it's a good idea with the markets at all-time highs? The answer is yes, because not all investments are at all-time highs. Not all investments are overvalued or expensive. There is always something to buy. And it is my job every day to find those ideas for investors. And for those that don't have an investment advisor, it's your job to do your homework and do your research to find these good quality names, even in a market that, if you look at it in the broader sense or in general, is overvalued, or at least fairly valued at best. Quick hits. 3 things that I saw, have seen in the news over the last few days, last few weeks, that I wanted to bring to your attention and make a quick comment on. First one, Apple launches new products and stock moves up. Stock did move up, and that's been the catalyst for Apple stock to go from about a 220 stock to a 250, 260 stock. And is the move justified? My opinion, I'm going to say probably not. Stock chill, still, company grows revenues in the high single digits. P ratio for Apple is somewhere around 34 times. So you want to pay 34 times for a stock that only grows, that doesn't even grow, doesn't grow profits by more than 10%. So Apple launches new products. We're going to talk a bit about that. Trump and Pfizer announced drug pricing agreement. This was just done the other day, yesterday, I believe, and it improved a lot of the drug stocks, pharmas, especially Pfizer. Gold climbing, as I mentioned earlier, $3,900 per ounce for gold, US dollars. Unbelievable. Something that I did not anticipate this year. So let's take our first one, Apple. As I said, Apple came out with this thin new phone. I think it's the Apple 17. I think we're all the way up to 17 now. Perhaps some improvements to the camera. And let's throw a chart on Apple. You're going to see the ups and downs of Apple. There they've been during the course of this year. It's been, here's a year-to-date chart. So again, a pretty big fall in the middle, April, and it has pretty much gone up since then. So am I a buyer of Apple at these prices? Probably not. I think from a valuation standpoint, I'd probably continue to hold if I own shares, but I'm not a new buyer. Our second quick hit or point that I wanted to discuss, and this is President Trump's Oval Office announcement with the CEO, Bourla, of Pfizer. And yesterday we saw Pfizer really do well. We have a chart, an intraday chart of Pfizer, and you can see, look at that. The announcement was made, and really from about 11 a.m. all the way to 4 p.m., the stock was up 7%. Stock still trades nowhere near where it used to during the COVID times, in the low to mid 30s, still in the mid 20s, pays a very good dividend. But this stock, make no mistake, I've owned it for investors for a long time, started selling off for many because it just seems to be dead money stock. For whatever reason, investors still look at it as a COVID type of investment, and they just don't want to give any credit to their oncology business, which they're big in. And now Pfizer is moving into the weight loss business as well. So big announcement by Pfizer and President Trump saying that Pfizer is going to manufacture drugs in the US and continue to do that and lower drug pricing. Very big thing, lower drug pricing. And many believe that a lot of drug companies will follow and bring down prices in the US. And you would think this would be a negative for profitability, but it was a positive for Pfizer stock. Our last quick hit is all about gold, and we can show our chart of gold in and around $3,900 an ounce. There it is. Gold continues to be this thing that, to be honest, I just don't get. I just think it's a trading vehicle. People are using it when they think that the US dollar is going to take a hit, they buy gold. If they think that the Fed is going to cut interest rates, and again, that's going to devalue the US dollar, they buy gold. If there's chaos in the world, more tariffs by President Trump, tariffs on furniture, pharmaceuticals, chips, whatever it is, people buy gold. Central banks, what are they doing? Central Bank China, buying gold, trying to diversify away from the US dollar. So I look at gold as more of a trading vehicle, a hedge against the US dollar than anything else. Gold is not used really for anything other than for jewelry. So the fact that it is trading at pretty much all-time highs, to me, just tells me that individual investors are using it as a trading vehicle. Now the part of the show where I like to take one question from our audience. And that question, a little bit different today. How important do you think it is for investors to hold dividend-paying stocks to protect themselves from market swings? Very good question. I think it's really important. I think if you own dividend-paying stocks, it can definitely insulate you to a certain degree against market swings. If you have a stock that's paying a 5% dividend and the share price of that stock drops by 5-10%, well, if it falls by 5%, you're at break even for the year because the dividend pays you 5%, stock falls by 5% and you break even. If it goes down by 10%, well, now maybe your portfolio only drops by 5% because it has that 5% dividend being paid to you. And usually, not always, but usually the dividend payers, such as bank stocks, such as utilities, pipelines, they tend to be a little bit less volatile because of that reason, because they pay good quality dividends. And anytime that that stock pulls back, obviously the yield goes higher because it's what it does, what a stock does, it pays a set dollar figure. So if it's a $5 on a $100 stock, it's 5%. But if that stock should drop to, to $20 and still pays $5, well, now that's 20% dividends, or 25% dividends, I should say, a quarter. So it just depends on the share price of the stock as compared to the dividend that it's paying. Overall, I would say that dividend stocks are definitely a good quality, a good idea. Again, as the question asked, to protect people from volatility. So with that, I want to say thank you to everyone that tuned in today. Hopefully, we were able to answer some of the pressing questions that many investors, many of you that are watching have with respect to market being overvalued, or tech stocks, or tech bubbles, and all of that. And hopefully you were to, all of you were able to take at least one thing away from today's show. I want to say that hopefully everybody will be able to tune in 2 weeks from today, which will be Wednesday, October 15th. I can't believe it'll be already October 15th at 12 noon across pretty much all social media channels where we will broadcast our next show. And until then, as always, I want to wish everybody a happy investing.